Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to That Annuity Show. Today we have a full complement of our co-hosts. Mark, welcome.
Good morning, Paul. How are you?
Good. Well, good to see you. We're spending a lot of time together on products and offers that cross all kinds of interesting sales and compliance issues, right?
Yeah, time well spent. Good to be here, Paul.
Yeah, and of course, Ramsey, what would the show be without you? And you brought a very interesting guest with you today.
All right, thanks, Paul. As always, love being here. And today we're joined by Bobby Samuelson, and this is a great opportunity for us. I think we're episode 86, 87. We've talked about a number of things. We have not had as very many product experts with a level of sort of depth of expertise that Bobby has. So I'm expecting this is going to be a very interesting conversation. Just a little bit of background on Bobby. He is the founder and editor of the Life Product Review. In my discussions with him and having read some of his material, I would describe Bobby as somebody that is both a builder of products, a very established builder of products, but also, and this is very interesting, a very skilled decoder of products as well. And, for that, I think we're going to have a lot of interesting things to talk about today. Bobby previously has been a number of places, most recently before founding LPR, if I can call it that, was working at MetLife, where he had a variety of roles. So with that, Bobby, I'm gonna hand it off to you and tell us a little bit more about yourself and what brought you to this sort of the specific passion and how you executed in the market.
Yeah, great to be with you guys. I'm a big fan of the show. So Ramsey, thanks for reaching out and asking me to be on. How did I get here? I don't think anybody in the insurance industry has like a great story for how they got in the insurance industry. I mean, nobody wakes up and says they want to do this for a living, at least as far as I know. And I'm no exception. So I'm the third generation of my family in the life insurance world. My dad started selling insurance in 82. My mom started selling insurance. She was actually rookie of the year at Principal before she had me. And then her dad was also an insurance agent, and he started selling insurance in the 60s. So I kind of grew up in an insurance family. I mean, it's definitely in my blood. I took a different approach. I'm more mathematically minded. I like statistics. That was kind of the first thing in school that I got interested in. And so when I graduated college, I got a job at NFP, which at the time was the largest distributor of life insurance in the country. And I will never forget, I sat down and ran my first life insurance illustration. And I thought, where did all these numbers come from? And I turned to the guy sitting next to me and I said, what is this? And he said, oh, it's just some actuarial stuff. And that from then on out, man, I've been passionate about it ever since. I love insurance product. Life insurance is kind of my first language. So I spent a couple of years at NFP, went and started my own company, did 5 years, basically independent consulting on the life insurance side. Went to go work at MetLife in the life insurance area, but as the whole Bright House MetLife split happened, I ended up with a lot of annuity responsibilities as well, running product development and pricing for life insurance and annuities. So I kind of speak annuities as a second language. Left there in 2017, and now I'm doing the Life Product Review, like you said, writing an article kind of once a week for a technical audience for life insurance. I give 50 to 60 presentations a year, do some consulting work. And then, like you said, I do some product development work on the life and annuity side as well. So that's a brief overview of my background. Like I said, I'm happy to be here and I'm excited to talk about product with you guys.
Fantastic. So tell us a little bit about sort of Life Product Review. And you said you write every week.
I do.
How do you, first of all, it's a lot of topics. That's 50 topics a year.
Yeah.
How do you figure out what to write about, and what are some of the more recent important topics you've covered?
Yeah, great question. Early on I was worried about having enough to write about. And so I kind of keep a running list of topics that I know that are kind of rolling around my head. And that if I, push comes to shove, I've got to write an article. I know I can sit down and write an article on that. So I kind of keep a list of 20 to 30 topics on that. And it's all sort of product related life insurance stuff. I don't write about annuities unless there's a kind of a intersection between life insurance and annuities. And so one of the things I've found in the business is that a lot of people who are on the annuity side know little to nothing about life insurance. And a lot of people on the life insurance side know little to nothing about annuities. And I remember this sort of enshrined at MetLife because when I took over both departments and merged them together, we had an introductory meeting for people to meet each other on the life insurance and annuity side. That's how separated it was. So anyway, I'll write about annuities occasionally. But in terms of topics, there's just, carriers are coming out with new products all the time. Lincoln, for example, rolled out a few days ago their new MoneyGuard product is Market Advantage. It's got a VUL component to it. I'm going to write a review of that product. There's been a lot of tax law change this year. Section 7702 changed at the end of last year, beginning of this year. Tons to write about there. I've probably written 4 articles on that so far this year. Sales pitches that I see, I write articles about that. I mean, it's kind of a continual list, and each article is 2,000 to 3,000 words, so they're not exactly short articles either. But I love to write, so it's one of my favorite things to do, and I'm never short. I feel like in an industry that for outsiders they probably feel like it never changes. For me as an insider, I feel like it's changing all the time, and there's always something interesting to write about. So yeah, that's how I keep it active. And I say it's an article a week, and it usually ends up being about 75 articles a year is kind of how it plays out. So it actually ends up being a little more than once a week.
Yeah, well, Bobby, yeah, thanks for joining us. I've heard just great things about the work you've done from a variety of people, including people who've worked with you and for you there at Met. So thanks again. Just extend my thanks for being on here. Retirement. Normally, most of our guests, you say retirement annuities or some derivative is sort of your natural go-to product.
Yep.
However, kind of like you, I've worked across a number of these product lines, and retirement's got a really unique place in retirement planning. And what I'd be interested to understand from your perspective is how has that role shifted, through this pandemic? As number one, we haven't had underwriting on annuities. But life insurance has had to adapt, and it's had obviously if you're talking about retirement life insurance, you're talking about older people who've got very different set of health risks. So can you just kind of tell us big picture, what happened last year here?
Yeah, I mean, there's a lot that happened last year, but I do think underwriting is a big kind of carriers had to react very quickly. And so if you look back 3 to 5 years ago, carriers started to implement these accelerated underwriting programs. And they were sort of, carriers were treading very lightly on that space. They would roll out a program. They might have it for just certain age brackets, certain face amounts. They would kind of create this little world where you could do these accelerated underwriting programs. When COVID hit, they basically had to figure out how to funnel a lot more of their business through those processes. And so one of the big things we've seen is a direct reaction to COVID, besides all the product stuff. And there's been a ton of product stuff going on last year in the last 12 months. But in terms of underwriting, carriers have really had to figure out their stance on accelerated underwriting, how to issue policies without the traditional information, how to do it without a paramed. I mean, that's another big piece of the puzzle. And I think one of the big upshots, I'm a big believer that disruption creates innovation, which I'm by far not the only person who believes that. But here we can see a clear example of that, where carriers were disrupted in their normal underwriting processes. And the benefits that the experience carriers have had in forcing things through accelerated underwriting will be a benefit for the long run for clients, because carriers kind of had to take the plunge. And so I think last year that was a big story of how the pandemic directly impacted life insurance. And to your point on the retirement side, for life insurance, you said it well. Annuities are typically thought of as kind of the retirement vehicle, but there's a whole cottage industry on the life insurance side trying to use life insurance for retirement planning. And one of the big hangups for using life insurance for retirement planning is the underwriting process. You don't have to be underwritten for an annuity, but you do have to get underwritten for life insurance. And so last year we saw this explosion of sort of quick issue programs without a pricing penalty that is now becoming very prevalent in the market. and even up to some pretty high face amounts. And that's kind of making life insurance an easier transaction for a financial advisor to position for retirement planning alongside of an annuity, or potentially in some cases in lieu of an annuity, which we can talk about. And obviously drop ticket asset management transactions. Life insurance is now a little bit more on an equal playing field because of these accelerated underwriting programs. And again, had it not been for the pandemic, it would have happened. It just would have taken 10 years. And
Hey,
instead,
Bobby,
carriers had to do it last year. Yeah.
Do you think that the pendulum's going to swing back, or find some equilibrium in the middle? What's your forecast?
Well, it's a great question. So it's interesting. Carriers took the plunge, and now you're starting to see some people kind of say, whoa.
Yeah.
Maybe we're relying on this type of data too much. Maybe we jump too quickly to certain conclusions about the efficacy of certain models. Maybe we didn't catch as many smokers as we thought in the underwriting process. I mean, there's a lot. This is really complicated stuff. But I will say this: will the pendulum swing back? No, but I think you will see carriers sort of refine. And it's not so much they're going to change the program; they're going to change the box that they allow it in. Maybe you don't want 65-year-olds; you just want 60-year-olds. Maybe you don't want over $1 million. You're just going to keep it to this kind of sub $1 million range. So it will, of course, kind of come back a little bit, but I think a lot of it's permanent. I think a lot of carriers have figured out they can do it. And they've forced the process, and now they like the process and they want to stick with it. They'll just refine it over time.
Can I ask you a quick question about that though? So the quick issue that you mentioned, so some of it is COVID driven within the legacy industry.
Yep.
But there are a lot of challengers that have come in, whether, I don't know, like Day Forward is a company that we featured in a prior in a prior event here on this show, and others are coming in and are doing this as innovators in the space. So I guess how much of the quick issue market you think will be driven by one force or another, and is there one you think is getting it more right than the other?
Yeah, great question. And I'm not an underwriting expert by any means, so I don't know all the details of all the different programs, but I will tell you this: behind every accelerated underwriting program, almost without exception, and there are a couple of exceptions in the market, but behind every one of those programs is a reinsurer. And so a lot of so it's kind of like factories in China, right? Somebody told me recently, you buy a mattress from any of the shipping mattress companies, and they all come out of the same factory, right? They just put them in different boxes. That's a little bit of what's going on in this accelerated underwriting market. Is you've got the reinsurers were the first ones to kind of step up and say, hey guys, you can do this. They go on for part of the risk, and those models, which again, most of the time are affiliated with a reinsurer and have a risk management arrangement on top of it, sort of feed into all of these different packages that we see out there. One reinsurer even has a white label company that literally all they do is just put products on their own paper and then white label it for distribution firms to make it look like it's their product. So there's a common set going on behind that. And that common set is feeding the startups and it's feeding the established players. I'll tell you where the startups have an advantage though, is the incumbents. The rest of the process can be very clunky at the incumbents. Something as simple as e-signatures. Some carriers are still struggling to figure out how to pull this off.
Really? Will, is that true?
I mean, it's
it is. It's a challenge. But like to Bobby's point, I mean, this has forced the hand a bit, the pandemic, and I think, but people are still struggling with this. Yes.
Yeah, and there's, I mean, you'd be, especially on the life insurance side, there's just a lot of thinking that goes something like this. If I loosen up this requirement, I will immediately have people who know it and take advantage of it. And so I have to be very careful about that. So anyway, Ramsey, to your point, I think the incumbents are more willing to think more critically about some of those assumptions about the overall process. Yeah. But there are, the new companies are willing to do that. The incumbents, I think, are going to catch up though. And there are already some really cool partnerships going on. I mean, I'll highlight, not just because I used to work there, but I highlight the Bright House Policy Genius pair up on that term insurance contract. I had lunch with Jordan Teal, the guy who kind of spearheaded that at Bright House last week. And, it's amazing to hear about how this incumbent insurance company basically pushed off, they had some issues with processing that they could now push off onto a firm like Policy Genius and, get some term insurance policies issued in a new way that would not have worked had it just been Policy Genius and had it just been Bright House. So I think we're going to see more partnerships like that going forward. And I think that's really encouraging.
That's an interesting one. Will the life insurance industry start to adopt more of an MGA model like the commercial side, or is it kind of back to the future, right? You get a GA contract, in 1910, and
Right.
you were doing the underwriting,
Yeah.
and doing all the servicing for the policies, right?
And I think that's a very interesting question, because that is what's happening with that deal, and it's working really well. So these things are always changing. There's always something to write about, and that's one of them.
Hey, Bobby,
Have you seen-
what are you thinking, or what are you seeing on the product development front for life insurance, given what we just talked about, given COVID, given changes in underwriting or accelerated underwriting, et cetera? Where do you see that going?
And just as a follow on, we'd be really interested in the senior market.
Yeah. Oh my gosh. That's a whole different animal. And honestly, Paul, I'm not as much. That market is, it's interesting when you look at the traditional life insurance market. To your point, like you made the joke about the GA contract in 1910. Well, that's with a career company, right? So
Right.
I feel like the market has really fragmented in a lot of ways, and you get these sort of self-identifying or these sort of self-sustaining universes. So there is a career universe. There's kind of a BGA universe that really serves, honestly, more financial institutions these days than independent agents. I mean, they still do both, but a lot of it is serving financial institutions. And then you've got the kind of multi-level marketing side of things, and then you have the senior market, and they don't really cross. I mean, there is some crossover, but it is not as much as people think. And so that senior market, which is growing dramatically, there's been a ton of M&A in that space. I mean, that is a lead gen market. That is a middle market solution, and there are certain companies that have just cracked the code on that. But anyway, that's not my world. I live more in the kind of BGA, financial institution side and career agency kind of side of things. So in terms of product, so it's been an interesting year, right? And so when we talk about silos, there's kind of the annuity life insurance silo. To some degree, there's also kind of the product and underwriting silo. So one of the things that has not happened, which you might have thought would have happened, is that there would sort of be this intersection between, hey, we're making changes on underwriting. How do we also make changes on product? They really haven't done that. What they've really done is kind of apply the underwriting to the product. And you haven't seen it really go the other direction, where you're seeing products built for underwriting. That's starting to change. You're starting to see some companies come out with some pretty interesting ways of sort of combining an underwriting program with certain policy constraints, but that's very uncommon. The main thing we saw in product last year was sort of the low interest rate environment. I'll call it the shock low rate environment. That sort of plummet in March percolate out through product pricing. So for example, on the indexed UL space, every single company except for one dropped their cap last year. Well, why did that happen? Two reasons. Number one is rates dropped, earned rates dropped. That's going to pull down on the portfolio yield. That's part of it. On the life insurance side, it's not as quick of an impact as on the annuity side. But the other reason is option prices got very expensive. Volatility popped, and more importantly, volatility skew popped. And so we had this incredibly expensive option environment. The best selling product in the industry on the life insurance side, besides whole life, is indexed UL. So that went straight to the heart of indexed UL. And then on top of that, a new kind of more punitive regulation also hit indexed UL. So there's been a lot going on in terms of product around COVID, but not directly related to COVID. And the big story is basically that, indexed UL now has a lot of headwinds that it didn't used to have. So we're kind of seeing the dimming star of indexed UL. We're seeing the rising star of variable UL. Companies are investing in the future of VUL. That change really got accented last year.
Interesting.
Really emphasized last year. Yeah. And then the last piece is, 1910 GA contract. I'll use your example again. Well, what product did that cover? That covered whole life. And everyone keeps counting whole life out. And the reality is whole life is still the dominant permanent product sold in the industry. It had a great year last year. And with the 7702 changes, it's set up to have a great year this year. And so part of the other big story was last year, everybody called, dividend rates are going to drop and this is going to be a huge problem for the big mutual companies. That didn't happen. Mutual companies were healthy. They sold a bunch of business, dividends held up, and mutual and whole life, I think, emerged sort of unscathed from an environment that took a big whack at its main competitor, indexed UL. So it was a crazy year in product, but I think it kind of capped off a decade of trends. And it was an inflection point to me. I mean, it really did mark kind of the end of this IUL dominance or this IUL growth and the start of something else. Not to say IUL won't be a part of that, but last year really did. There was a line that got drawn last year and the world seemed to shift. And so going forward, we're starting, I would argue, probably a new decade. And that delineating mark is 2020, which just happened to be COVID.
So,
Bobby, how about from an agent perspective? Given the accelerated underwriting, have you seen more traditional annuity producers moving more towards life products because of that? Or do you think that trend will continue going forward?
Yeah, it's such a great question. Short answer is yes. And it's not just traditional annuity producers. It's also, financial advisors at institutions that are traditionally used to kind of dropping a ticket. And now they might be willing to do more life insurance. Anybody who tells you that that's a wholesale change and it's completely upended the industry, that's not true. We're clipping around the margin here. The reality is underwriting is definitely an impediment to life insurance. There are other impediments to life insurance that I think are equally potentially as challenging. And so has there been a wholesale change? No, but have we started to see the first moves towards some of these producers now being willing to sell life insurance because of accelerated underwriting? And frankly, because the alternatives don't look as good anymore. So they're willing to kind of look at life insurance. Yeah, we've started to see some of that happen.
What are some of the other impediments that would be a barrier of entry for producers coming in?
Yeah, sure. So when you sell a life insurance policy, you are selling a recurring premium product that needs to be managed very closely. So if you're a financial advisor and you're a fiduciary, you're looking at this life insurance policy and you're saying, wow, this thing is complicated. It's got a lot of moving parts. How do I make sure that I provide good advice on this product? So I think the complexity of the product is one angle. The compensation is another angle. I think for some, especially fee-based or fee-only advisors, the fact that life insurance pays huge heaped upfront commissions can be a challenge. Now, for some other advisors, that's an inducement. So they want to sell that. But no matter what way you cut it, it also means that the sort of the liquid value of the contract is pretty low in the first few years. And so one of the challenges is you tell a client to put $50,000 in and they've got $5,000 of cash value. There's no other product out there that looks like, people complain about surrender charges on annuities. You put $50,000 into an annuity, you've got $43,000 of cash value at more than that in the first year. Put $50,000 in a life policy, you get $2,500. So if that. So it's like, I think there's sort of a barrier there. It's, it's complexity, it's commissions, it's surrender charges, and then it's underwriting. Right. And the underwriting piece is kind of getting solved, but the rest of it is still there. The fact is we need to make simpler products that are designed more for that market, like we've seen annuity companies do with fee-based annuities. That has not happened on the life side. It's still traditional, we'll call them B-share life insurance policies. That's still a predominant thing sold in the on the life insurance market.
So Bobby, same question Mark asked is just a little bit of a twist. So I'm an FI producer. Been doing this.
Hey guys, I'm sorry to interrupt. Paul, can you hear my dog barking in the background? Can you hear?
Don't worry about it.
Yeah,
we like dogs.
Faint, very faint.
Hold up. Okay, can we try this real quick? Okay, does that sound? How's the sound quality on that?
That's fine.
Can you hear the dog barking?
No.
All right, perfect. All right, keep going. Sorry to interrupt you, Paul.
It's called no. So Bobby, let me ask you the same question Mark did, just with a little different slant. I'm an FI producer. I've been in the business for 20 years. This stupid pandemic just kept me out of the seminar business. I've got this in-force block of clients. I probably have, I don't know, maybe 100 people I've talked to in the last couple of years. Should I, if I were to take your advice and look at life insurance, what are the first 2 or 3, ideas you'd have for me to go back to these clients and get a second sale?
Yeah. Life insurance isn't right for every client. So one of the things I worry about, and I can say this because I don't sell insurance and I'm an independent guy, so I worry life insurance sometimes is oversold, but there are situations where it can make a lot of sense. So let's take that FIA block. I'll bet you some of those clients don't really need that income. And what they really want is a legacy for their kids. And so to the extent you've got sort of legacy, estate planning issues floating around there, annuities are not a fit for that. Life insurance is a fit for that. So, in my mind, it's when you've got older clients who own a mature annuity, the question now is, what are you going to use and what are you going to leave behind? And I'll quote a study from BlackRock that basically said the clients don't spend enough money, is sort of what it says, because they are so concerned about leaving a legacy to their heirs. And so one way to use life insurance for older folks like that is to say, look, you kind of lock down your legacy, go on ahead and get a death benefit that you'd be happy for your kids to have. And that'll free you up to spend a little bit more liberally elsewhere, because you know that your legacy is insured. So I think there are angles like that. Now, say kind of roll it back and say we've got a younger clientele, you've got an annuity producer who's looking at annuities versus life insurance. I see a lot of life insurance guys selling life insurance like annuities. And I think that's where it gets a little bit tricky, is because you get guaranteed income in an annuity, now depending on the structure, right? But you can have guaranteed income in the annuity, and you have sort of non-guaranteed income in life insurance, but the rates look so much better on life insurance right now versus an annuity. So what I see is financial advisors sort of annuity advisors trying to kind of figure out, well, how can I sort of sell a life insurance policy instead of an annuity? The commission can be higher. Potentially it even looks better for the client, but you're kind of giving up on guarantees in the process. And I think that's kind of a tricky balance for folks that are used to selling annuities, because to the extent you have been selling guaranteed income, you can't really do that in the life chassis, but you can get it tax-free out of the life insurance policy, and the rates look better. So it's a balancing act. And I'm seeing, potentially more and more advisors trying to kind of sell both is kind of what it comes down to.
So Will, compliance hat on, what would you add? Would you modify? Would you,
Well, Bobby said it right off. Life insurance isn't for everyone. I mean, nor is an annuity. But I think what we try to do, and what an advisor should do, is take each individual circumstance on its face and see what clients' objectives are. And if it's legacy, I like what Bobby said. I mean, and it's really good to think about, if you're trying to save your money to give a pot of money to your kids when you can buy life insurance. I mean, that's a conversation that needs to have. I mean, what are your objectives with your estate planning? I mean, all these are valid. And it's interesting that that Bobby discussed, using life insurance as like a life insurance retirement plan of some sort, where you can take, tax-free loans out. I mean, I think as long as you're clear with your clients and they understand that they're taking loans and that, they'll need to keep that policy in force, or they potentially can have a problem. I mean, all of it comes back to transparency, figuring out what your client wants. But there's a lot of moving parts, and the compensation issue that Bobby mentioned as well for fiduciaries plays into it too. So I think that at least my thought process on it is to make sure that clients understand the discussion. But why not have a life insurance discussion while you're talking about annuities, and compare and contrast them, and how the interplay might work for their objectives?
I was fascinated listening to that Bobby, and in my view, I mean, it's, to me, like, I wonder, have you ever written about that specifically? Because I see it as sort of an if-then statement, right? Sort of like, if you want this, then that.
Yeah.
And a consideration is commission may be different, so you should know that. Like, in some sense, the decision tree can be sort of put out there so that you can sort of backfill for clients for which it makes sense, in a way that's fully disclosed.
Yeah.
Yeah, it doesn't even have to be one proposition. It's not a one proposition. Maybe it's both. It's an opening to have the conversation. And I think what happens is people get comfortable with what they sell and what they know. And that to the detriment of the consumer.
I completely agree. That's what I see all the time, is people get into a groove and they kind of, they get a hammer, so everything looks like a nail. And that's kind of what people do. But I'll say I'll give a little bit of in defense of that. I randomly get phone calls from people, like just folks who find me on the internet, the clients who have been pitched life insurance deals. So I got one pitch recently, very high-end advisor in Houston, fiduciary, very successful, working with this very high net worth client elsewhere in the country. And the client is the one that reached out to me. And he basically said, this guy's a fiduciary, does everything for me, but now he's pitching this life insurance deal to me. And so we got talking about it, and I ended up getting on the phone with the advisor. And what became very clear sort of right away was this advisor was an expert in investments and really didn't know much about life insurance, hardly anything about life insurance. So I think one of the challenges, or maybe one of the reasons why people stick with what they know, is because they don't feel like they can fully understand everything. And so that's why I'm a big fan of the sort of teams-based approach, where you've got a financial advisor that's partnered with other financial advisors who may be experts in other things, so that now a financial advisor can identify the need and refer to the expert on the team. And I think that works really well, because one person fully understanding financial planning, investments, annuities, life insurance, disability, long-term care, hybrid products, structured products. I'm increasingly seeing structured products being played, like putting that all under one and not to mention estate planning, business planning. That's a lot to swallow. And I think that's part of the reason why people just sort of say, I'm comfortable with annuities. For example, in an FIA, I know my client at least can't lose money. You can't say the same thing for a life insurance policy. So I'm not even going to have that conversation because I'm not an expert. And so it's always that kind of balancing act of how do you find people who are experts? What are you an expert in? And I respect guys who say, I'm not an expert. I'm not going to talk about it. Like there is something to that, but you have to go farther than that. You have to say, and let me refer you to where you can get more expertise here. And I think that's the missing part that a lot of times doesn't happen and should.
So Bobby, for agents and producers that are looking to really get into starting to do more production in life insurance, is there a standard kind of rule of thumb in terms of when to use which type of chassis, a whole life versus a universal contract?
I wish. I get a couple of questions pretty regularly. One of them is that question, and the other question is, can you put a grade on a product? And the answer to both of those, unfortunately, is no. So if you think about universal life is a flexible premium product. You can use it any way you want to. You can overfund it, you can underfund it, you can use it like term insurance. You can do whatever you want to do with it. And so it really, and again, this is where it's hard for advisors, I think, to kind of make that recommendation because there's so many different ways to use the product. But if I was a financial advisor and I was thinking about selling more life insurance, look, just have an uncomfortable conversation about mortality, which is way easier said than done. But every single client that you work with, whether they're annuity, investment, whatever, you should ask them about life insurance to at least make sure they're covered. Doesn't have to be the perfect policy, but the one conversation you don't want to have is with the client's spouse or partner after they have passed unexpectedly. And that spouse or partner looks at you and says, tell me about the life insurance. And you say, I didn't really bring that up because I don't like having uncomfortable medical conversations with my clients. Or, I'm very comfortable talking about investment risk, but not mortality risk. So I didn't really bring it up. And there's a great story. And one of the first stories I heard working in MetLife was I went to go visit a firm and they had a top advisor who had drifted more towards the investment side of the world and quit talking about life insurance. And this guy, the patriarch of a big family up in Boston, had died. And the matriarch looked at the financial advisor and said, now tell me about the life insurance. And he said, what life insurance? And the next words out of her mouth were, you're fired. End of story. So I think a lot of financial advisors, again, they get comfortable with what they're doing. Doesn't mean you have to be an expert in life insurance, but you should be having that conversation and bringing it up. And the other thing is, look, now that we've got Biden in office, I've seen the tax plan. There's going to be a lot more discussion around income tax planning and not just deferral, but the fact that you can get tax-free income out of a life insurance policy. I don't know what the amount of the income is, but the fact that income can be taken from a life insurance policy on a tax-free basis should warrant a discussion no matter what. I mean, that should, in terms of tax planning, that should be an option on the table. The client may ultimately say, the cost of the life insurance isn't worth the tax benefits. They may say, I really just want protection. I don't need the income tax play, but at least having that discussion with clients, I think is really important. And these changes to 7702, I think make it a little bit easier to have that conversation now because the limits have been increased. You can put more money into a life insurance policy than you used to without triggering adverse tax treatment. Marginal impact on the effect of the policy, but it's a good time to have a conversation with a client because something changed. And shoot, in life insurance, our tax treatment hasn't changed in 40 years. And it just changed this year. So that would be my advice is, again, have that mortality conversation, have that tax conversation, see where it goes.
Right. Great perspective. Thank you.
Yeah.
So let's see. Go ahead. We're at the close, almost at the end here. I don't know. Ramsey, final questions?
Yeah, way more than I can go through here. I would love to have you back. Would be great to get your continued ongoing sort of insights on what the tax changes mean, and then this tension between life insurance or sort of coexistence between life insurance and annuities, both as complements and as alternatives.
Yep.
Especially the alternatives one, because that's one certainly that I would learn from. I think would be fascinating, in terms of ongoing conversation. So thanks for what you shared,
yep.
And you'll hear more from me. I can promise you that, and probably the rest of us.
Yeah, thanks, Bobby. Great insights. Really appreciate it. Helpful conversation, and I think that what you hit home about the conversation regarding life insurance and how important that is for financial advisors is one that we have to emphasize.
Thanks.
Yeah, no, Bobby, I appreciate you being on. This is very insightful, and look forward to having you back in the future.
Thanks, Mark.
Yeah, Bobby, listen, thanks for time. Great to actually, connect with you. It's interesting. All our paths sort of cross at some point. As we all said, I'd love to have you back. I think the issues you brought up, I think, are going to be at the forefront of people's worries. Taxes, taxes are not going to go down. I don't think anybody will expect that unless mortality. Yes, we're all going to die. And continue to die. And then what do we do with interest rates, right? And how does this? How do these products all address and solve important needs for people as they move through life? So, Bobby, thanks so much. Let me ask you, what's the best way for people to find your research or follow what you do and what the types of questions you pursue here?
Yeah, sure. I try to make it as easy as possible. It's www.lifeproductreview.com. Most of the content is for subscribers only, but there are a few public articles laying around, but that's the way to find me, www.lifeproductreview.com.
Excellent. All right. Thank you. And thanks all of you for listening to another episode of That Annuity Show. Please share the shows and episodes with your friends and give us all the feedback and give us suggestions on future guests we have on our show. With that, thanks everybody, and have a great weekend.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.